The information provided in this podcast is for educational and informational purposes only and should not be construed as investment advice. We are not financial advisors, and nothing discussed on this podcast should be considered a recommendation to buy, sell, or hold any security. All opinions expressed are those of the hosts and guests and are subject to change without notice. Listeners should do their own research and consult with a qualified financial advisor before making any investment decisions. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. Before we begin the podcast today, just one disclaimer for you. We're here today to talk to Steve Gorelik with Firebird Management. And as a disclaimer, Firebird Management may own securities mentioned in this podcast. At the time of the recording, neither Donnie nor myself held any positions, but Firebird may own positions mentioned in this podcast. That's a disclaimer for you guys, and please sit back and enjoy. Thank you. All right. Hello, everybody. Welcome to Value Cville, the podcast. Glad to be back with you guys this week. It's been a few weeks, Donnie, since we've wrapped with everybody. How you been, pal?
Yeah, doing great. We keep adding to the list of people who are coming on, and today we have one that's kind of been mind blowing for me to dive into ahead of it. So I want to get into it.
Yeah. I'm very excited to have Steve, or we are very excited to have Steve Gorelik here with us today with Firebird Asset Management. Steve's coming live from London, a place that I need to get back to. I haven't been to London in a while, Steve. So I need to visit you there. We can talk some more about these ideas and have a proper pint. But Steve, so I thought the way we could do this, maybe let's just start out, give us some background on yourself, your investment philosophy, Firebird. And then I know you're here today to talk about two very interesting Eastern European banks that, you sent us the information on it prior. Donnie and I have both looked at them, and these seem, I can't wait to talk about these banks. But let's start out with you and Firebird, and just lay out kind of your worldviews when it comes to investing and how you think about capital allocation.
Thank you, Jeff. Thank you, Donnie. And it was a pleasure to meet you guys earlier this year at your conference. I thought it was great. Definitely, thank you for having me on the podcast. To give you a kind of a little bit of a history about Firebird. So Firebird Management has been around, is best known for investing in Eastern European public equities. It has been around since the early 90s, and it was one of the first ones. So the fund was launched in order to take advantage of the opportunity that was presented through Russian voucher privatizations. So this is a relatively famous story in value circles. The whole Russian economy was valued at somewhere between $6 and $9 billion. And the people that understood how that process worked, a lot of them locals didn't really understand it, but the foreigners understood it. And they saw that there was an opportunity in coming in, buying these vouchers that people didn't really know what they were trading them for a bottle of vodka, but there was an opportunity to buy this voucher that could have been traded in for a piece of a company. So initially the fund was launched to take advantage of that. But what makes it was launched by 4 people. Two of them are still running the firm today. But what made Firebird different from a lot of the other funds that were launched, the vehicles that were launched at the time to take advantage of the opportunity, is that we started looking at, it wasn't just a trade to take advantage of this one particular thing, but we started looking at opportunities and how is the whole region developing and what opportunities would be created over time. So as a result of that, we were one of the first portfolio funds that started investing into places like Kazakhstan, the Baltic countries, Romania, Bulgaria, Georgia, when that opened up for investing. And that's really what differentiates Firebird from a lot of the other funds kind of from that era in the 90s. I've been with the firm, so the firm has been around for more than 30 years. I've been there for almost 20 years. And the reason for why I was attracted to it, so I went there straight from business school. But the reason why I was attracted to it, I'm originally from Eastern Europe. I went to business school to learn more about investment management, buy-side value investing. And when I learned that there is a fund in New York that practices fundamental investing in the region where I'm from, that I was still interested with, I thought it was just a natural place for me to try to convince them to see if I can help out. And long story short, it's been 20 years. I love the firm. I love the people I work with. I'm really having a blast every single day, and I happen to get paid for it. So there's really nothing better in the world, and you guys know that. That's the beautiful thing. There's a lot of horrible things about our job, but there's a few beautiful things about our job, and that to me is it.
Well, you have to focus on the beautiful, not the horrible, right? That's my
That's
philosophy.
right. And then
Yeah.
from investment point of view, I think in the simplest, in the simplest way that I can explain it, we try to understand how companies make money and how companies spend money. So make money is the focus on a competitive advantages. Spend money is capital allocation. And then on top of that, since we are dealing with emerging markets, so the fundamental part is trying to understand the company. That's really just the beginning of the analysis. Because when you are dealing with the emerging markets, Eastern Europe, like what we are dealing with, there is a large portion of what we do on a day-to-day basis is understanding the macro, understanding the environment in which these companies operate, understanding the players behind them, understanding how the rule of law works in a particular country, what kind of protections you have as a minority investor in that country. And that's a big part of the value add that Firebird has with the 30 plus years of investing in Eastern Europe. We wouldn't feel comfortable doing the same thing that we're doing in other emerging markets because we know what it takes for us to do what we do well in Eastern Europe. That's why we took the fundamental part of what we're doing and we started applying it to the US market about 12, 13 years ago, but that's a completely separate conversation. And I know you guys want to talk about these banks.
Right. Well, yeah. I'm excited to talk about these banks for a multitude of reasons, but one is based in Georgia, the other's based in Kazakhstan. Quick trivia for my friend Donnie there. Kazakhstan, all right, one of my favorite cyclists of all time is from Kazakhstan, a guy named Alexander Vinokurov. And he runs the cycling team there, Donnie. Do you know the name of that team? I'll give you a clue. It's named after, I believe, the capital city.
Oh man, this is now I'm trying to really dig into the Jeopardy here. Let's see, the capital of Kazakhstan. I don't know. I got to pass on this one. I'll phone a friend. Steve, do you know?
Well, I know the name of the capital. I don't know the name of the team.
It's the same.
So the capital is Astana.
So Astana is the team, yeah. And the guy that's running it, he's a famous Tour de France rider, this guy Vinokurov. Anyway, we're not here to talk about cycling, but
Yeah.
we're here to talk about banks. But I just wanted to throw a little loop to my buddy there, Donnie.
Yeah.
Okay, so a couple of things before we just dive in here, Steve. When I think about mispricing, I like to try to think of the layers of mispricing, right?
Yep.
So obviously these are, let's just start with the idea these are two banks. I love looking at banks because banks are a special type of investment that requires a bit of a nuanced kind of knowledge of how banks work, how they make their money. You know, most companies as value investors, we value on an enterprise value basis. Well, enterprise value is kind of a meaningless concept for a bank when interest income and interest expense are operating items, not financing items. And so you immediately have to look at banks through a different lens, right? Things like asset and loan growth become very important, right? Net interest margin, cost income ratios.
Exactly.
Everything, as I said, is valued on an equity basis. So we're looking at equity multiples, price to book, price to tangible book, PE, these things. And so a lot of people that I've met in the value world, they won't even look at banks because they don't feel that they're equipped to have that type of specialized knowledge. So that is like the first thing when somebody pitches me a bank, I'm like, well, it could be mispriced. There's not as many people looking at it. Because it does require kind of a specialized knowledge. Then you couple that with a bank in Eastern Europe. So now not only do I need to understand how banks work and how to value a bank, I need to understand this Eastern European dynamic. There's macro forces, there's geopolitical dynamics. And so immediately when you said, okay, I want to talk about some Eastern European banks, it's like, okay, these could really be mispriced because it takes a unique person to spot the value and to value it correctly. And so I think that's kind of as my starting point on why, if the listeners are out there thinking, well, why would I want to think about an Eastern European bank? I think that's immediately why you'd want to think about an Eastern European bank. So with that in mind, I'm just going to let you start talking about these two banks in any order you want. And then Donnie and I can kind of follow up with questions. But I guess maybe to start, what attracted you to these two specific banks? Why do you believe that ostensibly they look very, very undervalued? We'll talk about the low PE multiples here in a minute, but why do you think they're mispriced? And kind of how do you go about unpacking the value creation, the mispricing, the valuation discount, and the opportunity that enterprising investors who dig into these issues might be able to benefit from?
So, Jeff, I think you've partially answered the second question that you asked through that great introduction. And because this is so far outside of the comfort zone for most people, most of the investors. This is why these opportunities exist. But before we go in there, I kind of want to spend just a minute on why we like investing in banks in emerging economies in the first place. To us, so half of our portfolio is banks or financial institutions that are within different countries, not just these two that I'm going to talk about, but there's other banks that we like in other places as well. But this is just to for the purpose of saving time, we're just going to talk about a couple. But the reason for why we like investing in banks is that if you have a growing economy, you are, so usually these economies are growing at nominal terms of, call it anywhere between 7-8% to double digits, 15-20%. Depends on the level of inflation and depends on the level of the GDP growth. But you are talking about relatively healthy rates of growth. More often than not, the starting point for these countries that they are underbanked relative to Western Europe. And in order to measure that, we look at the measures as banking assets to GDP. When you're looking at Western Europe, developed world, you have numbers 150, 180, 200%, even higher. When we're talking about countries within Eastern Europe, more often than not, that number is below 100. It could be 80%, it could be 70%, depending on the country. Georgia, I think, is a little higher, at like 110, 120, but these are countries that are fundamentally underbanked. But what happens is that as these economies grow, if you have a dominant financial institution, which is what we try to buy, is you have all of the growth in the economy naturally kind of cycles through these institutions. So as a result of that, you get the growth of the economy being turned into going through the banks. And as a result of supporting the growth in the economy, they're able to, if they're well run, they're able to make a decent amount of money while supporting the economies. And so this is why, but the key is trying to find good institutions, because the problem with the banks, and that's something that part reason for why people are afraid of touching banks in the first place, is there's this saying that they're always at the scene of the accident. A lot of us have the memories of going back to the 2008 crisis, why what looked like reasonably solid institutions would disappear overnight. So how do you get comfortable with that? So the beauty of Eastern European banks, from our point of view, is that more often than not, they make vast majority of their money from what is a fairly easy to understand banking services. So they will make money based on by borrowing cheaply and lending at a higher price. Net interest margins are usually quite high within these countries relative to what we used to in the West. Then they have some fee income that could be, it could be some kind of brokerage services, it could be money transfer services, could be things like that. But they make money on that. You see very little complicated financial transactions, which is what got people into trouble in the Western world back in 2008. So we have high quality financial institutions. We have business models that you can relatively easily understand. And there are different measures that help you understand the quality of the balance sheet. So we look at things like loan to deposit ratio to try to figure out how they're financing themselves. We'll look at what's great about IFRS is that within that accounting system, you can see you can look at the cash flow statement, and you can see the interest collected and compare it to the interest accrued. So you can try to figure out whether all of the money that the bank says it's getting, it is actually getting. Because sometimes that could be one of the red flags when there's large differences within that. So there's different measures that can get us comfortable investing in the banks in the first place. Also within these countries, quite often you will have locally owned institutions, and then you will have, and this is really more of a case for banks in countries like that are more in EU portion of Eastern Europe. So when you're looking at countries like Romania, you will look at countries like the Baltic countries. You're going to have institutions in there. You're going to have locally owned institutions, and then you're going to have subsidiaries of foreign banks. It could be Italian, French, Scandinavian, etc. We like to invest in locally owned institutions because we feel that they serve their customers better because they make the decisions locally. The decision, quite often the loan decision is made quickly locally as opposed to needs to go through the levels of approval that quite often involve somebody from the West. So they do that. And second, more often than not, you will have really high quality people that have come up within these countries running these institutions, as opposed to somebody from Scandinavia, whoever, who is being sent to some kind of insignificant subsidiary or relatively insignificant subsidiary. So from that point of view, we think that we have quite often best people running the best institutions, and that's why we like the setup, and that's why it's been a significant portion of our portfolio for quite a while. With the two banks, Danny, sorry, go.
Yeah, no, I think that's great setup. I mean, when I think about banks, I know there's the ratios, but I'm a pragmatist in a lot of ways, and I think if you go back to lending institutions, whether it's going back to Shakespeare or the money lenders and biblical times and the remarkable story of risk, if you sort of think about the underwriting of lending in a sense, what only matters is if you who the people you lend to are going to pay you back this money. I mean, you can break everything down. We can talk about everything else, but like that's the most important thing. I think even in America, we're 50 different states and there's a lot of regional banks, but I like to think of us as like we're about 10 different countries, and people here, you'll get guys in certain parts of this country which will lend to anybody and try to collect. And so when I think about it, I think you touched on a few things that really started to get me very interested. One is the people, where I would just start with and a little bit is like the culture of these banks and how much they are integrated in this community. If I'm a online bank, I don't know the person, but if Johnny, the neighbor, is the guy lending me the $10,000 for my business, I'm much more likely to pay him back. And you can see that actually playing out on a micro level here in the United States in a lot of ways. There's different institutions that take advantage of that. When you think about these countries, I think I'm really just trying to understand, like, I mean, who you're giving money to somebody, are they going to give it back? And like, how do they really starting there, make that like part of the culture of these things?
Right. No, I mean, you're exactly right. But I think it's even beyond that. Is that not even who you give the money to, but where you get the money in the first place. So the big portion of what makes these particular institutions attractive is that they are the natural. So the two banks. Let's just step back for a second. The two banks that I want to talk about. One is from Kazakhstan, Halyk Bank, and the reason why I chose these two is because they're relative to the other things that we do. These are relatively easily accessible because they both trade in London. So one is
Okay.
Halyk Bank, and the ticker for that one is HSBK. It's in London, and it's about 6.5 billion market cap in dollars. And the second one is Bank of Georgia, which is also it's actually called now Lion Finance. It also trades in London, and the ticker for that one is BGEO. And the market cap for that one is kind of also around the same level, I think. So it's about 3.6 billion pounds, so call it like $4.5–5 billion. So they're relatively accessible and liquid by the standards of our region. And that's the reason why I chose these two. The thing that they have in common is that each one of them has the domestic deposit market share of about 40%. And that's massive. So if you compare it to US, where by law you cannot have, so our biggest banks, the JP Morgans of the world, the Bank of America, they have market share of about 10%. They cannot be any higher. It's by law, right? So it's one thing when you have, it's essentially think about combining 4 JP Morgans, and this is the institution. So they are, if you want to have money saved safely, you're going to be put within these countries. You're going to put it within this bank. And because of that, actually your cost of borrowing ends up being cheaper than some of the competitors that have to compete for the deposits, because this is the same thing to do. And then the same thing, going to your point about how they lend the money, is that so they're able to either charge the same as the market rate or maybe even a little higher as a market rate, because they have such a high market share, because they don't really need to compete for the attention. So because of that, so you have the net interest margins that, as a result, generally quite wide. You're looking at 4, 5, 6% net interest margin, which would be unheard of in US or in Western Europe. And it's the difference. So they are able to pick and choose who to lend to. And they are the natural place where people go and deposit, safe place for people to deposit the money. And as a result, they have high net interest margin that helps them support very high returns on equity. The competition is also kind of very benign. So like this, now we have to talk about them slightly separately. So in Kazakhstan, there used to be 3 large banks. Since 2008, for various reasons, the other 2 have failed. And now there's 1 large bank remaining, which is Halyk Bank. There are competitors, and the one that's probably best known to the investor community is this bank, Kaspi Bank, which is also listed in London. But this is something that it has come up as more of a retail institution and serving SMEs, and has done a fantastic job within doing that. But it is now more of a e-commerce payments company and involved in places like Turkey. So it's a more complicated story than that's probably, we don't have enough time to get into that. But as far as the corporate banks is concerned, this is the institution in Kazakhstan. And I'm talking about Halyk Bank. So from that point of view, there are competitors out there, but they're not really, they're not significant. So they can pick and choose who they let in. In Georgia, it's even more interesting because there's two banks that each one has 40% market share. So it's Bank of Georgia, Line Finance, and the second one is TBC Bank, which is also listed in London. And each one of them has a 40% market share. And the way that they compete with each other, so they compete with each other, but not on pricing, but on quality of service. So if you take a look at their offering that they would have through their digital apps, we would only dream about that in United States. The type of things that you can do on the app in
What's
Georgia.
like an example of that
Yeah.
that gives you,
As
what?
far as like you can pay any kind of bill, you can, which I think we kind of used to at this point. But as far as like how easy the interface is, like in terms of money transfers, number of clicks that it takes, how easy it is for you to add a payee, how easy it is for you to pay any kind of municipal services. If you want to do a money transfer to a different currency, it's all just remarkably easy and thought through.
Okay, that makes a lot of sense. Yes,
The
I hate
QR
one of my banking
payments.
apps is
Yeah, the US is way behind here. I lived in the UK for 3 years, and I was shocked at how much easier it was to bank in the UK.
And then
Not opening an account,
take
that's
it further.
hard. Once you have it, it's like great.
Yeah.
So yeah, I totally get it.
Right, and that's kind of, you take it even step further once you get to the emerging markets, because they don't really have the problem with the deal of these legacy systems that
Right.
all of these banks in US and in Western Europe are dealing with.
And so
yeah.
And also, just I did not say, but give us some numbers here to give us an idea about the profitability these banks earn too, because I'm sure you're going to get into the return on equity story, but that was mind blowing to me.
Yeah.
Like
Okay.
the level and the consistency with which they were able to earn returns on equity that would far exceed, in my view, even a stretched estimate of the cost of equity. I mean, these guys are creating classic economic value, right? So maybe walk us through that a little bit.
Sure.
Just
So
yeah,
okay, so Bank of Georgia in Georgia is so if you read, and they're very good in terms of the communication with investors. So if you take a look, they always say that they run their business to earn returns of equity of 20% plus. If you read more carefully at the KPIs of the management, it's actually the KPIs are set on earning returns of 23 to 25%.
Yeah, that's great.
In reality, they usually, in the last few years, they've generated returns of 27% plus. And all of 27, yes. And all of that is done on a capital base that is significantly higher than what, and so you had a question earlier about the regulators. Mm-hmm. So this is done on return on capital base that is significantly higher than what we're used to in the West. So for Bank of Georgia, their capital adequacy is around 15%, compared to if you look at banks in Europe, you're usually talking about single digits.
Right, and you're talking about tier one, like the prime capital, right?
Yeah. So with all the buffers.
Correct.
Right. So CET1 would be in the teens, and then on top of that, you have some additional instruments that gets you to 15, 16%. But all of these are well above regulatory minimums, and the regulators are reasonably conservative. And part of the reason for why for regulators, it's kind of a relatively easy job in a place like Georgia, because you have two banks that is 80% of the system. So you have to make sure that these two banks are good.
Right.
The other banks, you still have to deal with them, but you need to make sure that these two banks are good. That's why they have
either one of those and shit hits the fan, so to speak.
Exactly.
Yeah. If you just contextualize these returns on equity, I was looking up regional banks in the United States earlier, and this is data provided by NYU. Here we get 6.8. I'm just pulling up the data around on regional banks, 6.8% in the United States. The money center banks are higher than that. They're about 11.5%. This is according to them. Or plus 20% is like a phenomenal return. I mean, it's like it's just something. It's kind of mind blowing to see that be very consistent over the years. That's almost like tech returns on equity in some sense.
Well, but that's because your NIM is 5% instead of 1.5%, too. We're talking about net interest margin.
Yeah. Right.
Also,
Yes.
the other thing is the cost income ratio. Is that the cost income ratio for these guys is like 40% or even less, which is once again a lot lower than what we would normally see from the regional banks in the United States. And
It's been a
that's
while since I've looked in the US, but yeah, regional banks in the US are going to have cost income ratios much higher than that from what I
yeah, I
remember.
think usually you'd look at like so specialty finance companies in the US, so like the Synchrony Financials of the world would be in the mid 30s.
Yeah.
But most of the banks, regional banks, I think in the 60 to 70 range.
Yeah. I mean, if you regional bank in the US, if you're around 50, that's considered really good, I believe.
Yeah. So
Yeah.
and
So,
we're
I mean, and then
much better.
also, not only are they earning these types of returns on equity, these net interest margins, but the loan growth, right? I mean, they're able to grow their books, at least from what I was able to see, is pretty impressive.
Right, and that goes back to the natural growth rate in the economy.
The economy, right?
Yeah. So if we Georgia for the last 3 years has been growing GDP in real terms at call it 7, 8, 9%. On top of that, you have inflation of kind of I think 6, 7, 8% as well. Right. So if you combine
Right.
these two, then you have nominal growth of teens, right? And
So,
then yeah,
no, so I know we're going to come back to the inflation question in a minute, but on the loan growth itself, do you know roughly what percent is split between, say, consumer loans versus business? Like, if you break down the book roughly, what's that breakdown look like, and how much detail are you able to get into the actual loan book? I know a lot of people look at banks and they're like, well, there are these black boxes. We don't really know what type of loans they're making. Do you have any color there on kind of the breakdown of loans, kind of like broadly consumer versus business, and then the different industry verticals that they're focused on?
right. So I don't remember off the top of my head the specific breakdowns. They do break down commercial loans, retail loans, and SME loans. So all of that information is available within their annual reports and within their quarterly calls. So all of that information is available. Most of the growth recently has been, so what happens within these countries is quite often the SME and retail loans do grow faster than large corporates. So they are driving the growth, but all of these segments are growing because the economy is growing. But that
Okay.
information is available now. I just need to follow up on it.
So if I'm to like sum up thus far, right? It's a bank that we're Bank of Georgia. I'm sorry, that
Yeah.
we're focusing on. It's a low rivalry duopoly, and they controls majority of the super majority of the market share. So and that allows them to earn this kind of super economic profits, if you will, or well above market economic profit, right? So all right. But now it's the time to like push back. So the story with the state of the country of Georgia is where I think if you were listening to this cold, you'd say, okay, but there is a lot of sovereign risk, there's geopolitical issues, etc. Contextualize that for someone who may just have not heard, who doesn't know much about Georgia, where it is geographically. I mean, I know we can all look it up. I had to, go and refresh myself, make sure I wasn't talking about the state here.
Do they do
Which,
boiled peanuts in both Georgias? That's a question.
yeah, do they do
I
both?
think,
Well,
I
yeah.
think the country of Georgia is more about hazelnuts. Not sure about boiling,
Okay,
but it is more about
gotcha.
That's a
hazelnuts.
good one. That's a good one.
That's a good one. Yeah, I love hazelnut coffee. Actually, I'm drinking some hazelnut coffee right now, so
There
that's
you
good.
They're
Great.
reasonably significant supplier to Ferrero Rocher. So the candy
Okay.
maker,
Yeah,
Yes, yeah.
hazelnuts within that candy. A lot of that comes from Georgia. But that's not a trivia question.
And then before, and
Yeah.
I know, Donnie, you're getting into the macro real quick. I don't know if we've said it yet, but just so the listeners have an idea, we've described these, what sound like very well-run, profitable institutions, the multiples at which they could be
All right,
purchased
go
at.
ahead. Yeah, that's a great
Hey,
question.
then let's do the macro. Yeah, these are not expensive stocks.
Well, I think the multiples are explained by Donnie's question. So
Yes.
because Bank of Georgia is currently trading at about P. Halleck Bank trades about 4 PE.
So,
And the
one is 6 and one is 4.
reason for why we feel the reason for why they're trading at those multiples is because for most people, for most investors that are not naturally looking at this region, they will look at, do I want to touch banks? Not really.
Yeah.
Do I want to touch Georgia and Kazakhstan that are in a pretty weird neighborhood and you don't know what kind of rule of law is there and you don't know what kind of relationship with Russia do they have and you if you look at the headlines, especially Georgia specifically, looks like there's political turmoil. So it just kind of goes into the too hard pile for most people. So it becomes a market that is pretty much, to us, is marginal buyer of these securities. More often than not, is the person with the local opportunity cost. And the local opportunity cost is set, to us, is set on what is the risk-free rate in the country. So in Georgia, I think the risk-free rate right now is 9.5%. In Kazakhstan, it's 17. On top of that, you put the equity premium, and you can pick a number, 8, 10, 12%.
Yeah, right.
And then once you get to that opportunity cost, you end up at about 20%. So in case of Kazakhstan, you get to 25. In the case of Georgia, you get to about 16, 17. And that's how you get to the multiple. Right. So this is kind of from the point of view of why they're trading at these prices, because this, if you think about from a point of view of the local cost of capital, then it kind of makes sense, especially if you're not willing to pay for growth that, as we have discussed, has reliably been there because these economies are growing. As far as in terms of Georgia and kind of the situation in which it's in, it's one of the former republics in the Soviet Union, one of the 15 republics that used to be in Soviet Union. It's been an independent country since the early 90s. It had a fairly difficult beginning as an independent country. There was a lot of turmoil. There was a civil war. There was separatist movements. And then in 2004, you had this person come in who was democratically, popularly elected, Mikhail Saakashvili, who came in with a popular mandate to restructure the country. And during Soviet Union, I'm originally from Belarus, so you kind of like, during Soviet Union, this country was known to be extremely hospitable, beautiful country, but extremely corrupt. And this is exactly how it was after the fall of Soviet Union. And this was the society in which corruption was permeated throughout. And one of the first things, but people were tired of it, and that's why they elected this guy. And one of the first things that he did is that he has fired every single policeman in the country. And he said, we cannot trust these people to do the right thing for us. So he fired every single policeman in the country, and he said, okay, here's the new rules. Here's how the police is going to work. We have to eliminate corruption. So if you're willing to work under these rules, we will hire you back, but it's only under these rules. And some of the people came back, other people.
What year was this, Steve?
This was 2004.
Yeah, saying that on an American podcast, there's certain states here are going to get some ideas. So I live in Minnesota, anyways. But yeah, no, so that's fascinating. Okay, so keep going. I think that's just so
Right.
it's been 21 years. This isn't like a new phenomenon. This is 21 years old.
So this was the beginning of modern Georgia and a different Georgia. And through that process, they took so the people, and he also invited back. So when Saakashvili came into power, he invited back all of the Georgians that have been really smart people that have been leaving the country to try to find a different kind of something to do in a better place around the world. And he said, come back and help me build a better country. And a lot of them did. It's a people that truly love their, and there's a lot of reasons to love them. So they came back and helped to restructure. And a lot of these people had the kind of very libertarian ideas from point of view of, there's like one example is that in order for a drug to be approved in Georgia, as long as it's approved in any OECD country, it's good enough for them. You don't need to go through separate trials. Like somebody else has done it for them. Why bother? It has become almost overnight, became one of the best countries to do business in. So it's quite amazing that because they tried to eliminate all of the ways that you had, where all of the ways that corruption came about in terms of interactions between the people and the government, they tried to eliminate them as much as possible. So now instead of having different departments, you have what in each city or town, you have government services building, where you come in on anything that you need to do, from paying your bills to renewing the driver's license to getting a permit to build the building. It's all in the same place, and it takes a day. It takes a day to open a business. It's like truly amazing. And so, but so Saakashvili came in and he kind of tried to build New Georgia, and some people were on board with it, other people were not on board with it. But over time, he's done a lot of good things, but he was also autocratic because he felt that he needed to be in order to kind of push through these changes. And by the time, 10 years later, by the time elections came about, he was no longer universally liked. So when he was initially elected, he got 90% plus vote in an open re-election. And then 10 years down the road, yes, the life was much better, but a lot of people were unhappy. So one kind of story that I tell is that I met a person just a couple of years ago, and I was talking to him about Georgia and about times of Saakashvili. And what he said is that, during his time, I had 5 friends that went to jail. Two of them deserved it,
It's not even
right?
50-50.
But it's these type of stories. So then there were elections. I'm trying to remember the year. I think it was 2016 or 2014, in which so he was challenged by this party, Georgia Dream, and he lost. It was a pretty tight election, but he lost. And the thing that he did that truly, to me, truly established Georgia as it is today, as much as what he's done over the first 10 years, is he said, I lost, I'm out. And he left the country. And
Left
from that point,
the country.
yeah, well, because there was different reasons, because like because of a lot of the things that were happening at the end, the new people that came in, and this is kind of in terms of similarities with with the U.S. elections, they said, okay, some of the things that you've done were illegal, so we're going to have a trial, and there's going to be a warrant for your arrest as a result of that. He's actually, that's a longer story, but he's actually in jail in Georgia right now because eventually he did try to. But that's a separate story, and that's what makes it complicated, and that's when people look at it and say, "Oh, this is too much for it."
Well, so I'm going to hone in on one thing you said, and maybe I'm jumping ahead, but you mentioned the local opportunity cost of capital, and I think one of the theories is, that if you have more non-local investors invest that have a different cost of capital, that could change multiples. But if I think about it, like if I go back to first principles, kind of interest rate parity, if I'm a U.S. dollar investor and I'm investing in a local currency, in these companies, and I'm getting local currency exposure, I kind of inherit that opportunity cost through the inflation. If the inflation differential is maintained at the current levels, I should expect to see a depreciation in the currency, the local currency, to the point where I have to have those high returns to offset the currency hit that I'm going to get when I translate it back to dollars. So, and I'm no expert, but just thinking through this out loud in my head, it feels like I have to have some type of macro thesis here. Otherwise, the return that I'm going to get in local currency is great, but I'm going to lose it all through the currency conversion back to dollars or back to pounds or wherever I'm at. So how do we think about that? Because I know part of the thesis that you have laid out is that you think there's a strong argument that real rates, which are very high in these countries right now, levels that you'd have to go all the way back to the early 80s in the US to see levels this high, 6-7% or something, that could actually bring inflation expectations down. And you actually could see a resetting of that cost of capital, which would have, a very powerful effect on the multiple at which these companies trade. And so, am I thinking about this correctly in saying that there is a macro story I need to buy into here for a times PE stock to really be a cheap stock from a US dollar investor's perspective?
Sure. Yeah, so I think I'll try to separate this conversation into pieces. So first of all, you are absolutely correct. Is that so? When you are investing in a bank in Kazakhstan or in Georgia, you are investing in essentially local currency because they're going to be earning a local currency. And the way that we're thinking about it, because the theoretical kind of first principles is exactly as you're saying, what is the differential between the interest rates and the inflation, et cetera. And then, but you can also see what has been happening over time. These countries have been around decades, and the currencies have been around for decades. And you can see that more often than not, the currencies depreciate at about 4 or 5% per year relative to the US dollar. Right? So we look at that 4 to 5% per year as a headwind against, we as US dollar investors, we're saying, okay, if we can earn 20, 25% in local currency, but we're earning 5% less in USD. And then when we are analyzing our investments in these countries, we're saying we're trying to see what we would earn in USD, and we take into account that currency headwind. Now, the second question, and the second part of what you bring it up is that what is the local cost of capital and is there a reason for it to change? And what's been happening over time, and there was like the reason why I started thinking about it, I think it was in May, there was an article in FT Alphaville that talked about, well, when there was a question of, is US an emerging market? And the punchline within the article was that, well, you kind of,
it seems like it.
That's a good one.
no, but the punchline in the article was that US is acting more like what we believe the emerging markets are than the actual emerging markets that have more conservative fiscal policy, that will run much smaller budget deficits, that will be a lot better capitalized, and have higher interest rates, real interest rates, and you don't really have presidents pressuring the regulator to lower them.
Right.
right? And this is exactly what's happening in Kazakhstan and in Georgia, where you have the real interest rates, as you said. So I think in Georgia, latest inflation is around 5%, and that has come down over time. So now it's about 5%, the policy rate is around, I think, 8.5. In Kazakhstan, the policy rate is
let's hold on Georgia for a second, just because we follow with the bank. What's the inflation rate in Georgia?
5%.
That's 5% inflation and then 5% real. I mean, inflation. I guess the story, it is that right?
GDP
what's
growth.
the
GDP
what are the
growth
real
is GDP growth is 8% this year,
Okay.
and
Okay,
inflation is
8%.
5.
Yeah, because inflation look, it has a fundamental cause, like a pragmatic cause. Either you can pick your, you could in the United States here you have fiscal policy or monetary policy, and you can kind of everyone has their boogeyman theory onto why we have this accelerated inflation for this long, right? And whatever happened in 2023 or whatever it was, 22. What I guess is driving the higher inflation in Georgia today? Is it because they've been fiscally or monetarily stimulating the economy, or is there something else that
No,
goes
it's
on?
it's just it thinks
But it's the high real rates of growth, as you mentioned. That's what's like kind of
so high
trying
real
to
rate of
marry the
growth
two.
is one thing. So within that, you have wages are increasing, so that's driving that's driving prices higher. One of the things that has been happening in the past, so actually we talked about currency earlier, but for the last 2-3 years, Georgian lari has actually done very well, relatively speaking. Usually because these are the countries that have a current account deficit. So when you have a current account deficit, if your currency is weakening, that raises prices locally. So that kind of drives inflation. That hasn't been a problem for them the last couple of years. So inflation has come down from double digits to 5%.
Are they running a current account surplus now, or just a smaller deficit?
It's a smaller deficit, but it's also financed by there's quite a bit of FDI going in, foreign direct investment going in. So one source has been the IFIs, so IFI funding for different projects within Georgia. Another one is remittances. So you have a lot of Georgians still around the world that are sending money back, and then you have large
so money coming back. That's offsetting so the current account deficit is pressuring the currency, but the FDI going back in is offsetting it. You're not getting as big a hit, on the currency, and then having to do import the second order effect.
And as a result of the of the war, Russian invasion of Ukraine, because of that, and because of the sanctions on Russia, there's actually quite a bit of regional trade that is being restructured to go around Russia that used to go through Russia. And if you look at the map of where Georgia is, it's kind of a natural conduit of what is called the middle corridor. So now there's significant investments in Georgia. Well, some of them are coming from Asia, some of them are coming from the West, but there's significant investments in infrastructure in Georgia, which is one of these pieces of FDI that is coming in.
Right.
And that's one of the sources of money that's coming into the economy. And all of that activity is resulting in an inflation, which 5% sounds high by our standards, by Western European or US standards, but actually by the standards of what it used to be within this region, it's actually reasonable and very low.
What if you were just to give high level Georgia, is the exports today, what is it primarily, and what's the infrastructure being built? Is it civil infrastructure, or are they building power plants to sell X widget or whatnot? What's the kind of driver today?
They as far as the exports is concerned, the biggest source of currency for the country is tourism. So it's a
Say it again.
Tourism.
Okay, yes.
Their GDP it's very much dependent on tourism. It's I think it used to be around 20% of GDP. I think it's a little less, but it's a country that is, once again, beautiful to visit. They welcome visitors, and a lot of people coming there. As far as their exports is concerned, from agricultural products, so they're big exporters of wine. It's actually a country where wine was invented. They have credible reason to believe that wine has been invented there 8,000 years ago.
And by the way, Georgia, are we far enough east where they were not affected by the thing that wiped out all the European grapevines? You know what I'm talking about? So my understanding is that most European wine, or all European wine, actually had to be regrown from U.S. vines because they had some like blight or something that happened.
Yeah.
People are watching this probably know this, and they're like, I'm saying it all wrong. But my understanding is the further east you get, you actually get true old world vines. Do you happen to know?
I know what you're talking about in Europe. I'm trying to think. I think they had bigger issues as far as it wasn't the blight that created issues for the Georgian wine production. It was the Soviet policies.
Okay.
Because at some point,
That'll get you every time.
you know, right? Because I think at some point, and I could be mixing up my history, but I think at some point, almost all of the wines that were there actually just were cut, and then they had to
Sure. Okay.
produce new ones. And then during
Right.
during Soviet times, the wine that was produced there was actually pretty crappy because it was for the domestic market, and people wanted just this like semi-sweet. And my parents drink this stuff. Like it's not good, just to put it simply. But
But now, is it? I don't know if I've had the Georgian wine. Are the wines pretty good?
now the
I was
wines
gonna
are
say,
good.
Steve, May, you're signed up now to bring the wine to the Value
Yeah,
Siebel
in
event,
May.
and
I will
Raj and George
oblige.
Wine.
yeah, especially maybe if you have an 8,000-year-old bottle, that'd be great too. But
8,000 might be a little
that might be
difficult.
a little
But
older. Yeah,
there's that.
yeah.
But what in terms of, I mean, we're kind of talking about everything here. But
Yeah.
as far as the reason for why Georgian wines have become good is because in 2008 Russia invaded parts of Georgia. And then after that, so then they kind of found a equilibrium after that. But also right after that, Russia has completely cut out Georgia. So it used to like 90% of Georgian wine used to go to Russia. And then Russia has cut all of the exports from Georgia. So as a result of that, it was complete devastation for the local wine industry. But B, they had to try to figure out how to go to different markets. So then, and how they go to different markets? Well, you have to have a different quality product. So that was the beginning of the out of that horrible situation, you had like kind of rising like phoenix from the ashes. You had a beginning of the new Georgian wine industry that started producing high quality wines. And also, I mean, right now, this is internationally recognized. You have wines that have gotten best in show, in decanter, and like you have truly some of these wines are truly amazing, have amazing history, especially like if you go, there's this historical way to produce wine that uses massive clay pots that has they're called quervies that will produce that is especially useful for white grapes, and you produce this beautiful orange wine that is quite delicious. So there's like a lot of now it's good. I would not be embarrassed to bring a bottle of Georgian wine and that comes with a story and a taste and everything.
Amazing how capitalism, improves things, right? When I was, as we prepare for this call, I was looking at kind of headlines where we are today in Georgia. You mentioned the '08 invasion of Russia. It sounds like there's it's a bit of there's a protest, or at least I don't know if they're still going on, but it was almost like a year of protests, pro EU versus like how, I mean, this is we're talking about an investing podcast. So framing that in light of the investment thesis, like what happens if we go EU? Does it all of a sudden actually, does it make it a less attractive investment, or if it goes a different direction, like where and how much do you focus on this on a daily basis? Like, does this keep you up at night, these kind of activities?
Doesn't keep me up at night, but we do think about it and talk about it on a daily basis. This says, so Georgia is in a very difficult neighborhood. It has already been invaded by Russia. And if Russia really wanted to, I think it could get to the capital within a matter of a couple of days. There's really very few things that Georgia can do about it. And the people that have come into power, and I'm forgetting the year, was it 2014 or 16, they've started taking a much more pragmatic approach towards Russia, not trying to antagonize it, but saying, okay, we know where we are, we have to be friendly with Russia, but the population wants to go west. I think 70% of the population believes in the Western way of life and wants to eventually join the European Union. So they're trying to balance these two things. So they have popular elections. There was elections last year that the opposition claims that they were rigged. And reality is that so ruling parties won, I think something, they said that they won something like 55% of the vote. In reality, they probably won somewhere between 45 and 50. So they rigged it. But it's kind of like in most places, a ruling party will somehow advantage itself. But the question is like, what would happen without it? Like if they wouldn't have done that. In the way that the Georgian parliament is set up, they would still be the majority party. Because and one of the only thing that the opposition was four different parties, like larger ones and then smaller ones, and the only thing that they could agree on is that they didn't like the ruling party, right? So and they didn't really have a cohesive platform that they could go with, because the ruling party also said we're for EU, we want to go into EU, we just want to go there on our
Right.
while kind of keeping the balance of other regions. So that includes not just Russia, but also includes people like China. So given where you are, they have to take all these things into account as a country that is within the region that it is. So we try to look at it, and this is like, so yes, you have the political headlines, but with the thing, what we do as a follow-up to that is we talk to businesses in the country. So we talk to our portfolio companies like the Bank of Georgia, it's now called Line Finance. So we talk to them, but we also talk to smaller companies within a country, trying to understand whether the business environment is changing as a result. And the answer is no. So as far as the ease of doing business, it's the same. The people in power understand that the reason why they stay in power is because of prosperity. But the ruling party, what their sales point to the populace was, look at how you're living today, look how well the economy is doing. And this was kind of on their part was not necessarily the greatest move. And then in their election posters, they had pictures of here's prosperous Georgia and here's war and destruction in Ukraine, and say, which one do you prefer?
Yeah, it's heavy. Yeah.
So we're the party of stability. And frankly, most people in Georgia today are better off than they are 10 years ago. Definitely better off than they are 20 years ago. So this is saying, they're saying like, we just will continue doing the same thing. But part of their social contract with the populace is that the economy will continue to improve, that people will continue to do better. And that's why they got reelected while maintaining a path that kind of tries to steer between European interests and regional interests. But going back to your question, from point of view of the activity in the economy, so if you look at things like the volume of FDI and what happens in the economy, ease of doing business, all of that is staying up. So you have the headlines and then you have the reality.
So that metric gives you the stability, is like the stability metric that you're really following.
Right.
Because like if you look at America and you think of, our headlines, your face would melt, right? But then when you look at a company like Google or Amazon, they're just doing well, and it's you gotta have to look past that. That's interesting. Just on a Jeff, if you have something, go ahead. But I wanted to kind of steer in for a second. I'll kind of take a right turn, but I'll let you go. Go ahead first.
Well, so yeah, I don't know if this is the direction you don't want to go, Donnie. We can pivot later, but I did want to ask. I had two questions that that I wanted to make sure we address. One is capital returns, both dividend and buyback. What does that look like for both companies? And then two, for me, when I look at something like this, I always want to know who I'm in bed with, right? The shareholder base. Are there any concentrated owners that, whose interests might not align with the rest of the shareholders, with foreign shareholders? Is there any risk of something, in the stockholder base that we should be aware of? Those are my kind of two questions. So if you don't want to go, Donnie, if you want to go in a different direction, we can.
I think that's great. It kind of rounds out the story completely, Jeff. So I think you nailed it, and I'll ask mine after that.
Okay. So as far as Bank of Georgia is concerned, the shareholder story is very simple. There's no majority shareholder. It's majority owned by Western funds from around the world. By funds from around the world. It's listed in London. There's no major, and it's kind of unique from that point of view. So this is you have it's a professionally run company that's part of 50, fully listed in London, on its way wants to become part of FTSE 100, part of different indices, and so it's no different than any other company that you would see that is UK based. So that's as far as Bank of Georgia is concerned. As far as Halyk Bank is concerned, it's a little more complicated. So you have the majority shareholder there is the son-in-law of the former president. Until today, it's kind of funny we're talking about it, but they own 70% of the bank. They just did a placement for 7.5% of the bank today, so now it's 60%. But this is the majority shareholder. And if you take a look at the history of Kazakhstan, so he's related to, he's the son-in-law of the former president. The new president is in place. He was the prime minister under the former president. There's been an attempt at a coup a couple of years ago within Kazakhstan, not to make things too crazy, but there was an attempt at a coup by some of the relatives of the former president that felt that they were kind of falling out from their place under the sun. That was it ended up going nowhere, and it was kind of fear of what would happen, whether this particular bank and the person behind it, whether they're going to be they're going to get affected by the changes in the government. Fairly soon after the coup attempt in Kazakhstan, Russia invaded Ukraine. It's two completely unrelated events. Okay. But after Russia invaded Ukraine, and before that, Russian banks in Kazakhstan had about, I think altogether had about 15 or 20% market. And what was a great data point for us that gave us a lot of confidence that everything is going to be okay is that Halyk Bank that had a 40% market share in loans to start with, was allowed to take over the largest corporate bank from Russia, their market share, because those banks had to leave the country. So there's a bank called Sberbank, which is the largest bank in Russia. I think they had something like 7 or 8% market share in Kazakhstan.
Right.
And Halyk was allowed to take over, or encouraged even to take over their loan book, because that was the most stable thing for the economy. And when you have the largest bank that is too big to fail by any stretch of imagination, like if something happens to this bank, and that's kind of like when you are dealing with emerging markets, you have questions about what is the loan quality. The central bank wouldn't allow a bank like that to have bad loan quality, because if something happens to this bank, it's a political problem. It's not even an economical problem. It's a political problem when 40% of the population has their pensions, has their salaries going to this bank. Like it would be a real issue. So when they allowed this bank to become larger, that gave us confidence that there's really nothing that's going to happen to this bank, and it's not going to be impacted by whatever political turmoil is there. Now, going to the second part of your question in terms of what happens with the money, as I was saying in the beginning, it's not just about how companies make money, it's how companies spend money. And we think, so the capital allocation within Eastern Europe is not a lot of people get. This region doesn't get credit for phenomenal capital allocation that exists. And so when talking about Bank of Georgia, they have their policies to distribute, I think it's 30 to 50% of profits via deposits, via dividends and buybacks. The other half is retained for growth. So this is still kind of a bank that's growing at 15, 20% per year. So the other half of capital that is generated is returned for growth. And half was paid out in dividends and buybacks. The dividend yield that you have is high single digits in the case of Bank of Georgia. In the case of Halyk, it's even crazier, because their ROEs is 30%, not 25, 27, but 30% plus. The reason for why it's that is because their cost income ratio is even lower. It's at about 20%. I think it's one of the very few.
They
It's
have
one
a
of the
cost
very
income rate of 20%.
Yeah. I would have to look it up, but I don't think there's a lot of banks in the world where cost income is lower than ROE.
I'm not sure if I've ever heard of that. That seems. How the hell do they have a cost income ratio of only 20%?
Uh,
Are they?
They're super efficient.
I mean, I think of like companies like I remember Bank of the Ozarks back in the day was always considered pretty good in the U.S. And I think it was maybe I'm totally guessing, but I think it was still like in the 40s or something.
No,
That's
these guys are at 20.
That's
But
crazy.
their net interest margin is right. So and it's kind of like
Yeah.
numerator to denominator, so it's all combined
That's-
I
together.
guess you have no marketing expense because you're the kind of the only game in town.
Exactly.
So there's
Exactly.
Yeah.
But
That's a
what
good
they
point.
do, so their growth rate is, so their normal growth rate in loans the last few years has been a little higher, but their normal growth rate is 5 to 10%. The ROEs are 30%, and they pay out 50 to 70% in dividends. So their dividend yield is double digit. So they usually pay like the dividend yields that they're paying out is usually around 12, 15, 17%. So you get, because you're buying it at 4 PE. That's the crazy part. And I know you guys had, I love the work that you've been doing and the guests that you had. And you guys had Paul Johnson on your podcast a few weeks ago, and kind of, because when I was in business school, I was studying with Paul Sonkan, and so they put out this book together in terms of Pitch the Perfect Investing, and
Great book.
so this concept of, I think Paul has done a great job on your podcast talking about the concept of earnings power value, and kind of what, not just earnings power value, but when you're pricing in growth and what are you paying for. If you look at these banks, you may be paying for current earnings. In the case of Halyk, and we take into account the local cost of capital, which in the case of Kazakhstan, it's 25%.
Okay, so based on local cost of capital, you're paying maybe for the current earnings.
Not even
for the current. Okay.
And then you're getting the growth on top of that. And then
the inverse of that chart. Yeah.
And if going back to what we started talking about, if the cost of capital starts going down because the real rates is so high and inflation is coming down over time, if that leads to the local cost of capital coming down, then if you go from 25% to 20, and the normal P goes from 4 to 5, that's 25% right there on top of whatever growth you're getting. So to us, this has been a amazing setup that has been overlooked for probably 10 years where these banks have compounded earnings without being repriced. So if you look at the chart of Halyk and Halyk Bank or Bank of Georgia, it looks like it just goes straight up, right?
Right.
And then if you look at it on PE basis,
Yeah. It,
You know,
this remind Donnie and I have talked a lot recently about how old school value investing philosophies don't apply to so many companies we look at today, especially in the US. But when I think about what you just described, I'm imagining like I wonder if this is what it was like to be a value investor in the 40s and 50s and have somebody come in and pitch a stock to you. Like it's just it seems so obviously a cheap investment. Donnie, you had a question. I guess my
Yeah.
final question is to be like, how does it end in tears, right? I mean, I guess it's some geopolitical event that we don't see coming. But I mean, like this, from what I'm hearing, sounds like a phenomenal setup.
Well, no, that's a good question. Like Steve, go ahead and address it. Where it is, what keeps you up at night, and maybe the easiest way
Yeah.
to say it, but
my kids, if anything. As far as how it can end in tears, so when you, I mean, what if anything, doing this for 20 years, if you think that the multiple cannot get lower, it can, right? So, right now we're talking about Bank of Georgia trading at, I think 6.5 PE, Halyk Bank trading at 4. After the war started, so in April or May of 22, all of these banks, all of the valuations in Eastern Europe came down by 40%. Not because the fundamentally this business actually improved, because as we were talking about earlier, now you have trade flows going around Russia, so you had an acceleration in growth rate within these countries since the war started. And you could probably argue that, okay, if there's ever peace in Ukraine, is it going to go back to some kind of normalcy? So will those growth rates come down? That is one of the things that we're discussing, and that's the question that you should be asking. But the risk perception increased, so the multiples have come down. Yes, the marginal buyer more often than not is local, but there are foreign investors in the stocks, and quite often they will sell first and ask questions later.
Dead margin of safety.
We're not particularly think within running a emerging market portfolio, we believe that you have to have a fair degree of diversification, because you never know. It's like coming into the so we used to have 50% of our portfolio was in Russia. Part of the reason for that was because we owned world-class businesses in Russia, trading at absolutely ridiculous prices. But now we don't have access to these businesses. We still have the shares, but we can't do anything with it. And I frankly cannot answer the question of whether, if this war ever finishes, whether the operating environment for these companies is going to be the same as it was before it started. So you don't know. So you're dealing with these risks. That's why we ran but it was 50% of our portfolio was in Russia. For a lot of people I know, they had 90, 100% of the portfolio in Russia because they saw that same opportunities we did. So this is where diversification makes a huge difference. And this is why we delivered the returns that we did over time.
Steve, over some Georgian wine, we're gonna have to talk about the being in 50% Russia, how that played out at another time, because that sounds like
at that point I lost some sleep.
Interesting time, for sure.
I would have lost some sleep either.
Yeah, let me so I'd take kind of a right turn in some sense, but just and maybe it's a good way to kind of wrap up, but I talk about like 1% IRRs, and these are just tools, techniques, habits that you can kind of immediately apply to get a little bit better, right? So I think just where I would what I would be curious to hear your thoughts on is, I listened to this and I'm super interested. I think you've made a compelling argument in this, but my reservation is, okay, Steve's from the area. He can understand cultural nuances that I can't understand. He understands maybe there's language barriers, there's legal systems that just I don't know if I can get. Now, fast forward though, and this is maybe an AI question too, is that you have all this compute power wind at your back today. So, I mean, I guess if you were to say, let's say I was a guy who was like, all right, I'm going to go spend my next 30 days just plowing and plugging to get comfortable with this. Do you think that, someone could do that, could get comfortable with all these types of things that are normally restricting and blocking someone from investing abroad? And two, like, what would you do? Like, where would you start to go and just get yourself comfortable?
So to answer your question, as far as like whether I have any competitive advantage because I'm from the area, I think when I started 20 years ago, and it's kind of interesting the way that Firebird is set up, is that the founders actually had nothing to do. They're not from Eastern Europe. So one of the 4 people.
So the founders of Firebird are not from Eastern Europe.
No, It's Americans. It was for Americans. One
Oh, it's
of them,
Americans. Okay.
yeah, one of them studied Russian in college, and so
Okay.
he speaks Russian. But these were for American people that saw an opportunity. The people that they have hired over the years, at least at this point, half of our people are originally from Eastern Europe. And part of the reason for I was hired is because my native language is Russian. I speak Russian. And at the time, 20 years ago, that was relevant because the Russian companies would report in Russian accounting standards, which was this unreadable 200-page report, of which maybe 15 pages were relevant and you had to know where it was. And that was my value at 20 years. I think it's been 10 or 12 years since all of these countries and the companies are mandated to report in IFRS and more often than not in English. So now it's no different looking at this as a UK company, a Swiss company, whatever it is. So now you're reading reports that are in English, you're talking to people in English. And yes, I have some local context, but that's not my value. And moreover, the people that started the firm that are much better at this than I am, that have been doing this for 30 years, their value add in just seeing the situations and pattern recognition and knowing what we know within Eastern Europe. So from that point of view, it makes us more, to your question of what keeps you up at night, I think because we have innate understanding of the companies and the people behind them and what they've done and what they haven't done, we feel more comfortable getting into situations. And then when you read particular headlines that may scare off some people, we may see an opportunity. And that's our value add. That's our core. As far as understanding these companies, I think the thing that is most important is meeting with them and talking to them and realizing that they're no different than that the people in charge of these companies are no different than the people that you would see seeing a US company. If anything, I would say that they have seen more things. So in 20 years that I've been doing this, I think I've been through 5 or 6 cycles, market cycles. I've been running a US fund for the last 13 years. I still haven't seen one, right? You had COVID, which was kind of a downturn, but not really. Yeah. So from that point of view, but the people that are running these companies, that they've been through multiple cycles and they know exactly what to do whenever there's a downturn. I mean, we've been talking about banks, but when you're talking about consumer companies, they know, okay, this is the time when the value of our marketing dollar goes further. So instead of pulling back on marketing, you can add to marketing and you can take your market share, and which helps grow your market share, and then you come out stronger on the other side if you're well prepared. But they are prepared because they've done this a number of times. And you develop appreciation for these people and people that run these companies, that it's not just cheap company, it's a fantastic company. Right. And the reason for why it's cheap has nothing to do with the company itself.
It almost creates an anti-fragility in a way if you've been through multiple of those cycles, because you know how to act, opportunistically, where if you'd not been.
And the regulators know as well. So it's the regulators have always also been through these cycles, and they know the mistakes, hopefully not to make.
So you would advise picking up the phone and just start calling, and you could get, obviously you can read the financial statements in IFRS and English, but you could also just get access to them and
you can
understand.
Get to the investor relations
them up very quickly.
Yeah, absolutely.
Oh.
Absolutely.
Well,
then
that's great.
They present. So if a person listening to this is a professional investor, you'll probably be able to find these guys at conferences and get they're open books because they want to see more people coming into the stock.
Yeah. Well, that's a helpful tip, and I appreciate that. So as I maybe continue doing some work on this, I'll start to reach out to them. So that's helpful.
Right.
Yeah.
Well,
I think it's been great. Yeah. Jeff,
yeah,
want to wrap it up?
Kind of at an hour and 15, which that's typically kind of where we start winding it down. I guess, Steve, any final thoughts on these investments that you want to leave the viewers with, and any, if they want to learn more about you, about Firebird, where can they find you? Just general questions like that.
So I think as far as these investments, we talked about it in quite a detail. And I think that, Jeff, what you've touched on is that quite often a situation that, and I find myself, I'm at fault as well. Like somebody will talk to me about a company and I will have this preconceived notion and say, you know what? No.
Yeah.
Right.
Yeah.
And it's the system 2 thinking that should kick in at that point and saying, well, clearly everyone or a lot of people doing exactly that. So maybe that's where the opportunities are. And it could be then you look into it and say, yeah, my first instinct was right. I should not have touched it. But sometimes after you dig, you will get to opportunities that show that they compound returns for the investors. It's not just hypothetical. It's actual returns that they have been compounded. So from that point of view, I think like that to me is when we're talking about a story like this, and I mean, I love the fact that because you guys are kind of coming into it from a fresh slate.
Yeah.
And like But you guys clearly have an open mind and ready to look at something like this. But I wonder to what extent, like from people that are listening to this, how many of them simply will see, okay, he's talking about a Georgian bank, I'm done. I'm not interested.
I think it depends on the experience that people have had buying low PE stocks. And I think we live in an environment today where, and I can raise my hand here. A lot of the times I've gone into a company that trades at a 4x PE, there was a risk that I didn't understand. There was something that, it might not be that I, lost my shirt, but it definitely did make the money that I thought. And there have been instances where I've lost my shirt. But that said, you're right. It doesn't mean that every 4 PE stock is some disaster and you shouldn't run into the building. But so my guess would be whether or not people will look at this seriously is going to be kind of a function of the experience they had. But I love what you say. It's like, don't just immediately disregard it because you think Eastern Europe, geopolitical risk, I don't understand, maybe crony capitalism, whatever thoughts come to mind might be, to your point, the exact thoughts that come to everybody. Oh, and it's a bank. I don't understand banks, blah, 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 blah. There's a loan book I'll never get. I mean, I can't understand a loan book for, a regional lender in the southeast of the US, let alone one in Kazakhstan, right? That's how people think. And but that's the opportunity, right? And so I think you're absolutely right to frame it that way.
And I learned that actually. I think we talked about this when we initially prepped to some degree. But in a past life, I worked with a company out of Estonia and visited the area. And I had initially, kind of the same view that Jeff mentioned. But as I got to know the company more, I mean, first of all, it was a phenomenal company. And second of all, just getting to understand the lay of the land and just how much innovation was going on, how much of the culture was forward thinking, very, on the tech forward front. And there was these different companies in there. And it was like, kind of hit me over the head there. And, maybe that's serving me well now, being open-minded in this area 10 years later. But, I do think that these areas, there's a lot of areas worth double clicking on that aren't natural for people who are just US-centric sometimes. I think you've done a great job at laying it out, so really appreciate that. And yeah, we appreciate you taking the time and explaining this in detail. This is great.
Thank you for having me, and thank you for listening.
Yeah. One thing I'll say too, when sorry, as I'm thinking out loud just through the investment, I mean, the levers that need to happen to make this thing work, at least from my initial thought process here, are not super correlated with the S&P 500, right? They're not super correlated with AI. They're not super correlated with it. I mean, it's like, yes, we need a geopolitical situation to work in a way that doesn't derail the thesis. We need the growth in these countries to continue. I mean, there are factors that matter, but they're not, to me at least ostensibly, super correlated with the other risks in my portfolio, which to me immediately makes me like this because I like taking uncorrelated return streams, uncorrelated risks, because that's kind of, well, that's what Markowitz taught us, right? You want uncorrelated returns that earn higher than cash, right? And so this strikes me as just that. And I think
Quick
that,
question. Sorry, a nuanced question. What will you get a dividend for these guys? What currency are you getting it in?
Either
You're getting
dollars or
US
pounds.
dollars?
So if it's Bank of Georgia, it's pounds, and if it's Halleck, it's dollars. But they convert it for you.
Okay. They convert it for you at whatever the prevailing rate is. And then
yeah.
And what would be that today if you were to the dollar and the dollar based one? What would the dividend rate be today? Do you know? I can look it up, but I just as Jeff was mentioning it, like the uncorrelated stream, it made me
It's
think
double
through
digits.
that as well. Double, okay.
It's double digit. Yeah, it's good.
All right, bringing us gifts today, Steve.
Well, Steve, this has been fantastic. I think definitely at Value Seaville next May, we got to get some of that Georgian wine, sit down and talk about. I do want to know what it's like to have 50% of your assets in Russia. Well, that's a good conversation starter with some Georgian wine. And really enjoyed you coming on. As always, enjoyed the conversations. It's folks like you that make our event in Charlottesville so great. And so, I want to thank you for being a part of it and adding so much value to our group. And that's all I've got. So, Donnie, any final thoughts from you?
I would echo your thoughts. And it was I had a wonderful time, Steve, talking to you in Charlottesville. We talked for a very long time, I think, at the later establishments. And it was a pleasure getting to know you. And I'm glad we get to continue the conversation here. So appreciate coming on.
Thank you for doing what you guys do. This is great. I really appreciate it.
Awesome. All right. Well,
everybody,
thanks for tuning in to this episode of Value Seaville, Value Charlottesville. Until next time, happy investing. Thanks, guys.